A stock market crash occurs when stock prices drop suddenly and unexpectedly. A stock market crash can occur due to a significant disaster, economic recession, or a long-term speculative bubble bursting. In response to a stock market crash, public hysteria may also be a significant contributor, causing panic selling and further depressing prices. The 1929 Great Depression, Black Monday in 1987, the 2001 dot-com bubble collapse, the 2008 financial crisis, and the 2020 COVID-19 pandemic are all notable stock market crashes. Okay, this one is popular because it is required for most companies with an online presence. Subscribe to Stock Monster for more riveting material if you want to stay up to date on new top inspiration to grow financially. Stay with us with just one click to the bell button. Let's begin with 5 causes of stock market crash you need to know. Stock market crashes are usually characterized as a sudden double-digit percentage drop on a stock index over a few days, but there is no fixed threshold. Stock market crashes regularly have a significant economic impact. 2 of the most popular ways for investors to lose money are selling shares after a sharp drop in price and buying too many stocks on margin before a market crash. The market crash of 1929, triggered by economic recession and panic selling, sparked the Great Depression and Black Monday, 1987, which was also primarily caused by investor panic, are 2 well-known stock market crashes in the United States. Another big crash in the housing and real estate markets occurred in 2008, resulting in what is now known as the Great Recession. The cause of the May 2010 flash crash, which wiped trillions of dollars from stock markets, was identified as high-frequency trading. Because of the outbreak of a COVID-19 coronavirus pandemic in March 2020, financial markets worldwide hit bear market territory. A stock market crash can be caused by several factors, including: Number 1, panic. One of the most common causes of a crash is panic. Stockholders who are worried about their assets' value will sell their shares to protect their investments. As stocks begin to fall, the fear grows, causing more sales and probably a crash. Panic selling is when many people sell an asset at once, causing prices to plummet. An investor, in particular, needs to get out of an investment as soon as possible, regardless of the price paid. The problem with the sale is that the seller is acting on sentiment and paranoia rather than analyzing the fundamentals. Most major stock exchanges use first trading, halts to mitigate panic selling by allowing customers time to absorb information about the sale and returning a sense of normalcy to the market. Anything from a significant market player going bankrupt to concerns about specific legislation's effects will cause thousands of investors to panic and sell their stock. It's important to note that none of these variables, on their own, are usually enough to cause a crash. A sudden drop in the stock market is generally caused by a combination of a negative trigger and investor fear. Number 2, speculation. Speculation was the primary cause of the 1929 stock market crash. When stock prices started to increase, more investors continued to buy to ensure that they did not miss out on good opportunities. In the 1920s, both new and old investors saw 20% plus returns on their portfolios, which attracted many new investors to pull all of their savings into stocks. Simultaneously, an increasing number of people began to trade on margin to benefit from the rising rates. This meant that as stock prices began to increase, more customers demanded more stock, causing the price to rise even higher. This is known as a speculative bubble, and it becomes precarious as more people traded with borrowed money. Speculation occurs when individuals and businesses invest in a sector in the hopes of seeing an asset or security rise in value or based on potential performance expectations. If the performance falls short of expectations and the hysteria fails to match fact, the bubble bursts and a mass sell-off occurs. Excessive speculation is to blame for many market crashes. Your enthusiasm is valued by us, so don't forget to subscribe to Stock Monster's YouTube channel and ring the bell to be informed of new episodes. And keep watching. Number 3, changes in the tax code. The new Tax Cuts and Jobs Act could almost certainly result in higher corporate profits, and it is likely to be a market driver in general. Tax rises, on the other hand, may have the opposite effect. Raising payroll taxes on employees and employers may be one solution to the Social Security funding crisis. There are a variety of ways this could happen, but it would mean lower salaries for employees and higher prices for employers, which would be a negative catalyst. If short-term capital gains or dividends lose their preferential treatment, if the corporate income tax is increased in the future, or if any other substantial tax increases occur, the same may be said. Although this is unlikely to occur while the Republican Party is in control, it is possible in the future. Number 4, inflation and interest rates. Increasing interest rates in general are a negative catalyst for stocks and the economy. This is particularly true for stocks with a high dividend yield, such as real estate investment trusts. These stocks are purchased mainly for their dividend yields, and increasing market interest rates put downward pressure on them. For example, if a 10-year Treasury note yields 3% and a particular REIT yields 5%, income-seeking investors may believe it is worth the extra risk to choose the REIT. If the 10-year Treasury yield rises to 4%, the REIT's dividends will need to grow, roughly in lockstep, to attract investors. Lower stock rates also mean higher dividend yields on a percentage basis. From an economic standpoint, higher interest rates means higher borrowing costs, which tend to slow down buying activity, potentially leading to stock market declines. As a result, if the 30-year mortgage rate increases to, say, 6%, the housing market will be severely slowed, with home builder stocks suffering as a result. Number 5, excessive leverage. Leverage, also known as borrowed money, can seem to be an excellent tool when things are going well. For example, if someone invests $5,000 in stock and it rises 20%, he has made $1,000. He'd made $2,000 if he borrowed another $5,000 and bought $10,000 worth of the same stock, doubling his income. When things go against you, though, influence can be perilous. It would hurt, but he'd still have $2,500 in his wallet. A 50% decline would have wiped him out entirely if he had borrowed an extra $5,000. When things go wrong, too much leverage will send stocks down the drain. When rates fall, companies and investors who have a lot of power are pressured to sell, driving prices even lower. The most notable instance was the crash of 1929, in which unnecessary stock purchases on margin played a significant role. These were the 5 causes of stock market crashes you need to know. Make sure to like and subscribe so you can join the Stock Monster Squad and be a part of the channel. Thanks for watching the video.